This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
In our previous session, we discussed, of course, the issues of how to account for the output VAT and the input VAT, both of which would be done in relation to a VAT return period. And since last time, I asked you to have a quick read through, of course, the basics in terms of these VAT return periods. The usual situation, as you'll have read, and as we have said many times before, is that most businesses will submit VAT returns in relation to a quarterly VAT return period. That, as we'll see in these notes, and you'll have read some at least about, is the usual situation. It is possible for different lengths of VAT return period to exist for certain businesses in certain circumstances. Again, more of that in a few minutes' time. So what have we got here, therefore? VAT returns are normally completed on a quarterly basis. Each return shows the total output VAT and total input VAT, as we computed again back in the previous illustrations in the last lecture, for the quarter to which it relates. All businesses are now required to file VAT returns and make VAT payments online. Oh yes, it's a brand new, well, hardly brand new, but it is a bright new digital world in which we live, and more about making tax digital in a moment. VAT returns, therefore, must be filed online and electronic payment made by 1 month and 7 days after the end of the VAT return period. So there we go. As we saw again in relation to that previous example that we did looking at output and input VAT, we saw how if you had a VAT return period to, say, the 31st of March in a year, then you'd have 1 month and 7 days. It would be the 7th of May by which the VAT return must be submitted and indeed the VAT payment made there. Again, it's the 7th day of the second month after the end of that return period, i.e., learn it that way, 1 month and 7 days after the end of the VAT return period. And all of this has to be done online. Again, this issue of online, it's rather more practical than it is in terms of exam significance here, but following the introduction of Making Tax Digital, most VAT registered businesses now have to use Making Tax Digital software to directly submit their VAT returns to Hmrc. It makes things quicker and easier for Hmrc to deal with if it's all coming through on a common platform, therefore. And it makes sense. Again, once the business is operating that system, it's easier to run, and it's much easier, of course, and hence why they want it done for Hmrc to operate it that way as well. So most VAT registered businesses now have to make use of the Making Tax Digital software so as they can directly submit their VAT return to Hmrc. And also, of course, to maintain the digital records that lay behind that. Again, what we'll see is there may be various compliance checks that take place at different points in time, whereby Hmrc may make a little visit to a trader's premises and ask to see the backup. And again, that backup now would be maintaining digital records to back up the VAT return. VAT returns, again, it is self-assessment. So every now and again, Hmrc may come a-calling and ask to see the basis of the VAT return that they have received. Again, just as we said, but for the example for the quarter ended 30th of June 21, a business has until, 1 month and 7 days, end of June, July, next month is August, the 7th of August, therefore, 2021, to file its VAT return online and electronically make its VAT payment, methinks there, to make that payment. So there's the critical date, 1 month and 7 days after the end of the VAT return period. And that will hold true whether, as we're talking about now, we're dealing with the most likely scenario of quarterly VAT returns, or the other most likely scenario, certainly in terms of an exam question anyway, and that is monthly VAT returns. Again, you'll have read through this, but it does seem odd that a chore submitting a VAT return that you could put off and do only on a quarterly basis that you might voluntarily choose to do on a monthly, a rather more regular basis there. And does seem to be making a rod for your own back. But of course, wherever something is done voluntarily, wherever there's a claim or an election that can be made by a taxpayer, it's usually to create, and will only be made if it does create, a benefit to that taxpayer. But more of that in a moment's time. The requirements there under the Making Tax Digital rules for the submission of the online VAT returns and the payment online, these requirements do not apply to businesses with a turnover below the VAT registration threshold of 85,000. But of course, you might be thinking, well, if you're below the threshold, you're not submitting VAT returns. Well, yes, you are, if of course you have voluntarily registered for VAT. Again, very simple exercise. We've already seen when we looked at, I think it was example 4, but that example whereby we had the output VAT and the input VAT, that we make that comparison. And if we're told here that for the quarter ended 31st of March 21, company had output VAT of 12,400, input VAT of 7,1, we'll take the 7,1 away from 12,4, and that return for the quarter ended March 21 should be submitted by, what is 1 month and 7 days after that? It's the 7th of May 21. VAT of £5,300. The excess of the output VAT over the input VAT is payable, and that's due to be paid as well by that 7th of May 21 date when that VAT return is submitted, or when the VAT return must be submitted by. As we said, VAT, as are most taxes, is a self-assessed tax. You submit the VAT return, you say what transactions have taken place involving output tax and input VAT. Hmrc make control visits to VAT registered traders. The purpose of a control visit is to provide an opportunity, of course, for them to check out the accuracy of those VAT returns. Again, like a little tax audit there going on. Now, we have said that instead of just doing it on a quarterly basis, a business may choose to submit monthly returns. Again, it's a bit like that, as we've said before, the old turkeys voting for Christmas scenario. Why would you do something that is, again, the proverbial rod for your own back? Well, of course, there is a very good reason why we might choose to take on the extra administration and costs associated with that extra admin in relation to this. Because we do not pay them. There is no point us choosing to make monthly payments to Hmrc when the payment could be deferred and simply done on a quarterly basis. But if, of course, we are regularly in the situation of having VAT repayments, Hmrc pay us, how often would you like to be paid? How often would you like the money to come in? Quarterly or every month? Every month then, please. Now again, we have to weigh up the amounts coming in compared to the extra costs associated with doing 2 extra returns. So doing 3 for the quarter rather than just 1 following the end of that quarter. But that's the reason why we do it, and that's the point made here. We'd only do so if it received regular VAT repayments. This would arise where the business has, of course, standard rated purchases and expenses that we incur, so we suffer input VAT, but we make 0 rated sales. Remember, not exempt sales. If we made exempt supplies, then we cannot register for VAT, we cannot recover input VAT. If, however, we make taxable supplies, then we are able to register for VAT and we will be able to recover that which is recoverable, the input VAT there. But if, of course, we are making 0 rated, then there is no output tax. So in that lovely situation where there's no output tax and there is input tax and we get the money back. Well, let's see if it's worthwhile. Let's do it on a monthly basis. And hence always had more input tax than output tax and therefore would claim a repayment. Another situation you may see, and this comes up in a later lecture, could be the next one actually, but accounting schemes, where there's various accounting schemes that HMRC have introduced to try to look after smaller businesses. Smaller businesses have a particular problem in terms of admin exercises, the costs that are incurred here, the potential for delay in submission of returns, etc. So they're conscious of the fact that they want to make life easier for business. We do not want a system that involves huge amounts of red tape that take these entrepreneurs away from what they should be doing, which of course is to run their businesses, grow their businesses, make bigger profits, pay more tax, employ more people, they pay more tax. We don't want to take these people away from that because you have to submit these particular forms and you have to do it this particular way and you have to do it that often. So what may happen as regards certain smaller businesses is, rather than submitting VAT returns on either a quarterly or a monthly basis, it can be done on an annual basis. Now, we'll see that, as I say, in I think it is the next lecture that we'll have together there, depending on how long this one takes. To be able to do that, it's limited by size, but it also doesn't mean that they only have to pay their VAT once a year. No, there's going to be payments on account that have to be made, where basically, what did we do last year? Let's use that as a basis for making payments on account. Then after the end of the year, then we'll submit the VAT return for the year. And if we haven't paid enough in VAT as compared to what it is for this most recent 12-month period, we'll pay over the extra. If we paid too much, then we'll get a repayment. But again, we're removing the burden of accounting for and submitting those VAT returns on either a quarterly or a monthly basis. But as we said, clearly, if you're going to get money back, and it's a significant amount of money, you would want to do it on the most regular basis possible, and that is monthly. At the other end of the spectrum, if we are a very large business rather than a smaller business, if a trader's VAT liability, note VAT liability, that's your 20% on your sales figure in relation to sales, the output tax less the input tax. So we're talking about very, very large businesses here. If that figure exceeds 2.3 million over a 12-month period, if the trader's VAT liability, that's based on the output tax on the sales less the input tax on your purchases and expense items. If that exceeds 2.3 million over a 12-month period, then these substantial traders, as they're known, must make monthly payments on account of their VAT liability. So they too have to make a monthly payment there, but a rather larger figure, as you may well appreciate. VAT invoices, again, I'm not going to talk you through that. All it is, you sometimes get, and again, I think they're pretty poor in terms of exam questions as a way of testing. We know it's objective testing, and here are 4 items. Which of these is not one of the pieces of information that needs to be contained upon a VAT invoice? Again, you'll find that in whichever exam kit or revision kit that you're using from an approved provider, presumably therefore either BPP or Kaplan as the big 2 in terms of such provision, but whichever you are using, you will see questions of that nature. It's just a learning exercise. Again, that sort of thing, have a quick read of it now, but once you've done everything else in your final revision, maybe over those last few days, you just have a little reminder there. But again, it's mostly common sense. If actually you work within the UK and you're in an accounting role, then you know, therefore, what appears on a VAT invoice, and it will be very easy for you. But again, that is something for you to look at. I wouldn't suggest you do it now, unless, of course, now is 2 days before the exam, which I certainly hope it isn't for you. But do that closer to exam date. There's a lot more important things to be filling your heads with rather than that sort of information. But yeah, it could come up, of course, as a Section A objective testing question. And that therefore moves us on now to looking at, well, we've said there that we've got VAT returns need to be submitted by these dates, and of course we have to pay by those dates, basically 1 month and 7 days after the VAT return period. But of course, businesses, whether small and having admin problems or whether large there, may miss the deadline dates in relation to the submission of that information. And that therefore is going to get them involved within the penalty system. So what we have to be aware of, therefore, is if you are late, either in submitting and therefore presumably also paying the VAT, but if you're late in either of those things, then we have what we call a default. And there is a default surcharge system that will then apply, and something we need to be familiar with. It's an area the whole area has been being reviewed for some time now, but our exam system has kept on, failing the introduction of a finally approved scheme, has kept on with the scheme that's basically an old scheme and we've had around for many years. And that's just a brief introduction to that. But basically, this is what you need to know so far as, yet again, our exams are concerned, even though out there in real life, there are some different things, different issues coming in. A default occurs if, as we've just said, a VAT return is not submitted on time or a payment of VAT is made late. What happens if you do that? Right, your card is marked, as it were, here. You may have problems in the future. But what happens? On the first default, Hmrc serve a surcharge liability notice on the trader. And the notice specifies a surcharge period, starting on the date of the notice, ending on the 12-month anniversary of the end of the VAT period to which the default relates. So initially, you don't have a problem in terms of, yes, you've missed that particular deadline of the 7th of whichever month it may be, but they're not going to hit you with a fine straight away or any penalty. They're putting you on notice for basically another year after the end of this particular return period, that if you do this again over the next basically 4 quarterly VAT return periods, over the next 12-month period, if you do this again, then we are looking in terms of a penalty system coming into play, and one that will increase the more such times that you have at default you miss one of these deadline dates. So we have, if the trader has a further default during the surcharge period, there are 2 consequences. The surcharge period is extended to the 12-month anniversary of the VAT period to which the new fault relates. So we start the 12 months all over again. So you might have gone through the first, again, on a 12-month period, therefore 4 return periods. You were okay in the first one, okay in the second one, then the third one after that, you got it wrong. And you submit late, another default arises. That's within the 12-month surcharge period, and because of that, they start the clock again from the next return period. So it's another 12 months there from the end of that third return period. So that starts the clock all over again. Surcharge period extended to the 12-month anniversary of the VAT period to which the new default relates. If the default involves the late payment of VAT, then the trader will be subject to a surcharge penalty. Right, if you're late paying, surcharge penalty, it's going to cost you here. There is therefore no surcharge penalty where the late VAT returns involves the repayment of VAT. But if we owe them, then yes, it's going to involve a surcharge. The rate of surcharge penalty depends on the number of defaults in the surcharge period. You get punished more and more the more frequently that you break the rules here. If you are a repeat offender, they don't keep hitting you with the same penalty. The penalty gets bigger. A sort of encouragement to not do it again. get your act together, get yourself sorted, make sure those VAT returns are submitted on time, and make sure, specifically here, that you pay the VAT on time. So once the trader is in this surcharge period, how much surcharge penalty will they incur if they do indeed commit a further default within that surcharge period? As we said, the more that you default there, the bigger the penalty will be. The surcharge is measured, this penalty is measured as a percentage of the amount of VAT unpaid at the due date. Well, the first such surcharge that arises because of a further default being committed within any of the first 4 VAT return periods, the 12 months following, therefore, the first time that a default occurred and the surcharge liability notice was sent to you. The first of these, we're talking about a mere 2% as a percentage of the VAT unpaid. And that's a small percentage, but it's made even more friendly for the trader concerned because surcharge penalties at the rates of 2% and 5%, that's both for the first, as we are discussing now, but also there for the second default occurring within the surcharge period. Actually, they won't be made for amounts of less than £400. Now, when we're talking about 2%, if my mental arithmetic is correct anyway, 2% of £20,000, that would be 400. So unless we're talking about an unpaid VAT amount as regards that first default within the surcharge period, unless the VAT unpaid for that period is in excess of £20,000, then this little de minimis provision here will apply, and actually we won't have to make that payment. Obviously, when that percentage goes up, then the level of VAT that we're talking about is going to be somewhat lower. And that's only applicable for the such amount of 2% and 5%. So only for those first 2 defaults. Now, as we said, hopefully you'll have learned your lesson and you won't do it again. Right. So this is a percentage of the amount of VAT unpaid. But if we're talking first or second, no such payment will have to be made if the amount involved those amounts are less than £400. Obviously, as we get to the third and fourth, or even more than that, in terms of those defaults that run through this surcharge period, then we're talking 10% up to a maximum of 15%. And where those last 2 apply, that the rate of surcharge is 10% or 15%, then the minimum surcharge, they won't bother again charging you this extra. The minimum surcharge we're talking about is £30. That will be the minimum amount that we have to pay. Obviously, of course, it's likely to be a lot bigger than that, but the minimum surcharge is 30. In order to escape, from the surcharge liability period, the trader must submit 4 consecutive quarterly VAT returns on time and also pay any VAT due on time. Now remember, that surcharge period can keep rolling forward. You commit a default, not only are we in danger of having to pay a penalty, but we start the 12 months all over again from the end of that particular VAT return period. Now then, in order to escape from that surcharge liability period, we've got to have 4 VAT returns submitted on time and the amount of VAT paid on time. Once that happens, then we're free and we start all over again. We will not have a continuing 12-month situation. We stop at that particular point. But of course, if coming out of it, you then, of course, commit a further default, then there won't be a penalty on that, but you'll start the process all over again. And those issues are tested out here in terms of example 6, where we have to state the consequences for the business, here a company, of the late submission of VAT returns. Well, the first thing you've got to identify is have any of those VAT returns been submitted late? The one they start us with for the quarter ended 30th of September 19. The VAT paid £3,100. When was the VAT return submitted and the amount of VAT paid? That was on the 5th of December 19. Well, is that okay? No, it isn't. Quarter ended 30th of September 19, 1 month and 7 days after the end of that return period. That would have been the 7th of November. So in which case, because we didn't submit or pay until the 5th of December, we will therefore have committed a default. What will now happen? Going back to our notes, a default occurs if a VAT return is not submitted on time or a payment of VAT is made late. On the first default, this is what we're seeing now, there will be the surcharge liability notice will be served, and that notice specifies a surcharge period, and that will run to the 12-month anniversary of the end of the VAT period. So, having therefore fallen foul of the system for the quarter to the 30th of September 19, we will therefore have a surcharge period that runs through the next one, the second one, the third one, the fourth one, to the, again, their 12-month anniversary. That'll be the 30th September 20. And if within that period we have further defaults, then of course we're into the penalty system, and that's where this table then comes into play. Right, so what happens? 31st of December 19, the next quarter, the first within the 12-month surcharge period, we're talking about VAT paid of 21,300. Now that's 31st of December, 1 month and 7 days after the end of that. That would have been the 7th of February there of 2020. But the payment wasn't made until the 2nd of March 2020. So we have our first default. You're going to have to work out in relation to that, how much, if anything, will that penalty be? You need to work out, based on that figure unpaid, this is the first default within that period, how much penalty will be payable, if any. You've also got to understand that because you've now had a further default, then instead of this surcharge period running out, as it would otherwise have done at the 30th of September, we're now going to continue on for 12 months after this return period, so to the 31st of December 2020. You now need to look through at each of these, just get that out of the way there, at each of these quarters, March, June, September and December, and looking at the dates that we submitted and paid the VAT, and determining whether those payments have been made within the scheduled time. Well, 31st of March 2020, April, May, so that would have been the 7th of May. It was in fact the 25th of April, so we've submitted on time. You repeat that exercise in relation to those there. I say those specifically to begin with. If we have met the required submission date and payment date within those next 4 return periods, as we have done to the end of March, and as you're going to establish whether you do, to the end of June, September and December. If you submit on time and pay on time, then that gets you out of that surcharge period. You've then got to see what happens when that occurs at for the quarter to the 31st of March 21. So I'd like you to have a go at that now, please, for yourself. We've started you off there. You should have the basis of making those stating the consequences. And then once you've had your go, again, come back and join us and we'll quickly review through the answer. Okay, let's see how we got on, therefore, with example 6. As we said in our discussions before we let you loose on that the late submission of the VAT return for the quarter to September 19 would indeed have resulted in Hmrc issuing a surcharge liability notice and specifying a surcharge period running to, well, the 12-month anniversary of when this return period had ended, and that'll be to the 30th September 20. We then had an immediate default with a late payment of VAT for the quarter to December 19. That, therefore, will result in a surcharge of, well, the VAT unpaid was 21,300. It's the first default, so it's 2%. That, all being well, is £426, if we've got the calculation correct there. But as we were saying before, we have for both the first and the second defaults within your notice period. If the amount does not exceed £400, then it wouldn't have to be paid. There's no requirement to pay. But this, of course, we've deliberately made that number bigger so that that comes out at more than 400, and therefore the amount will have to be paid. There will be that penalty to be paid. And of course, as we said, the surcharge period will then be extended to the 12-month anniversary of that return period end, and that will take you to December 20. But when you looked at the submission dates, we looked at one of those for the next VAT return to the end of March there. But what would happen in relation to the remainder? Well, all of those submission dates and payment dates were within the required 1 month and 7 days. So that meant, therefore, having submitted 4 VAT returns on time, we came out of the surcharge period. But then what happened? We then had a VAT return for the quarter ended 31st of March 21, which was submitted late. Will therefore, I say, only result in a surcharge liability notice specifying a surcharge period running to the 12-month anniversary of that, so to March 22. So rather than a surcharge penalty arising, we basically wiped the slate clean by going 4 VAT return periods, in on time, paid on time, and that brought the surcharge period to an end. We started all over again. Not a very good start because we've immediately fallen foul of the system, but that is not going to create any penalty. But it means that if we have another, of course, default within the next 12 months, the next 4 VAT return periods, then there will be penalties, depending, of course, with the first 2 on the amount of unpaid VAT and what your 2% and 5% calculation will come to. Back to the notes, therefore. Where are we? Et le voilà. Back to the notes. And a further bit of admin here, which again is basically a learning exercise. And plus, apart from one important change from earlier years, we now have certain information. You can see I've asterisked it here. That is the standard penalties for errors. The information that would otherwise be a dreadful learning exercise that you'd have to perform is now provided in your rates and allowances information in the exam. And that, if I quickly go to it, this is at the front, of course, of your study notes here. Here is given the standard penalties for errors. So the information that would otherwise have been a real pain to try to memorise that information is now provided. Now, the reason why I tell you that is because, when we return back to the notes, because apart from this issue here, you now have that information repeated down here in terms of you are now given the standard penalties for errors information on your rates and allowances page, so that information that previously would have had to have been learned, it now won't have to be learned because it's given to you. That makes the learning easier. But the reason why I'm telling you that is because the other stuff hasn't changed. All of the rules behind that haven't changed. What you have to know hasn't changed. And therefore, for the remainder of this particular lecture, you'll be listening to, you'll be again relieved to hear you won't be held have to look at me for the remaining part of this lecture. It's an older lecture, it's just an audio lecture, but it's just basically taking you through that. You can indeed read it for yourself in all honesty, but if you want to listen to me talk you through that, then feel free so to do. I look forward to, again, after this next bit that you see, the older, well, you can't see me, but the old voice here for me. I'll see you next time after that.
But in section 8 that we now move on to, we see other areas of where the penalty system also comes into play. Now, the first of those areas here in section 8.1 is way back at the very beginning of your life with VAT, and that is if you've had a failure to notify your liability for registration. The other part of this, which is the same rules, we've had a change in the nature of supplies by persons that have been exempted from registration, but now of course they're not. Now here what we'll discover is that there's a standard penalty based on a percentage of the VAT lost during the period from when the notification should have been made, and quite obviously through to when it is actually made. Now this standard penalties given here, the actual penalty payable is linked to the taxpayer's behaviour. Now that therefore runs from, at best, there will actually be no penalty at all where the taxpayer has a reasonable excuse for the failure to notify. So that's as good as it can get. No penalty, reasonable excuse for the failure to notify. All the way through to there being a penalty of 100% of the tax unpaid where there is deliberate failure to notify with concealment. Deliberate failure to notify, and with concealment you've tried to cover it up. In between we have got 30% and 70% of the tax unpaid as penalties. The 30% penalty arises where the tax unpaid there, where it's a non-deliberate failure to notify. It is a failure. Again, you don't have a reasonable excuse. It is a failure here, but it wasn't deliberate. So there, 30% of the tax unpaid. Where, of course, we have a deliberate failure to notify, the penalty goes up to 70% of the tax unpaid. And we'll see that type of scheme where we go from no penalty through 30, 70, 100% there. That we'll find also when we look at the admin systems that apply in terms of income tax and corporate tax. Again, a similar scenario will arise. What we'd also discover, though the detail of which we do not have to know, a penalty will be substantially reduced where the taxpayer makes a disclosure, especially when this is unprompted by Hmrc. So the taxpayer realises that there has been an error made and therefore owns up to that. And it is unprompted. The Hmrc have not said that they're going to investigate. And what happens is we discover as the trader, oops, we've made a mistake, and we go forward and tell Hmrc that. So if that happens, then the penalties are reduced. Again, obviously encouraging, therefore, taxpayers to, as it were, come clean in relation to as soon as they become aware that a mistake has been made, they actually do that. So they come forward and say, oops, sorry, we should have notified registration, now we're doing it. Once you're registered, as we know, if you are late submitting the VAT return or late in paying the VAT in relation to that return, we've got our default surcharge system. But what about now? The second section, where there are errors in the VAT return that we have submitted. So a trader that makes an error in a VAT return that results in the underpayment of VAT can be subject to a standard penalty for submission of an incorrect return. Standard penalty for submission of an incorrect return, and the penalties applicable to the submission of an incorrect return, which lead to the understatement of the VAT liability or a failure of inflated claim for repayment of tax, i.e. we have put in a VAT return that gave rise to a repayment of tax and actually it shouldn't. That was an inflated claim. We've discovered that there was an error and therefore we should not have had that level of repayment. Either way, we're not paying sufficient VAT or they are repaying to us too much. So there are submissions of an incorrect return leading to either of those two things, And then the penalties, again, similar to what we've just been talking about. No penalty. Taxpayer simply made a mistake, through to penalty up to 100% of the understated tax, where there is also concealment of the error. In between, 30% of the underpaid tax, 70% of the underpaid, understated tax there. 30%, the taxpayer fails to take reasonable care, as opposed to 70%, where of course the error was deliberate. Again, very similar to what we've just seen in terms of the penalties that arise when you fail to notify your requirement to register for VAT. Now, in terms of these errors in a VAT return, there may be the standard penalty computed as we have just seen for the submission of an incorrect return, and there may also be penalty interest. Now, the different situations that we may find ourselves in. The main issue that is tested and which we need to be able to do a calculation of is whether or not the net errors are less than a de minimis limit, or whether the net errors are more than this de minimis limit. Now, the de minimis level, this de minimis limit here, is the greater of, in terms of the error in the VAT return, either the underpayment of tax or the over-refund of tax, £10,000 and 1% of the turnover for that VAT return period. Notice this de minimis level is the greater of those two. Now, if the net error is less than that de minimis limit, then it can be voluntarily disclosed by the trader, and correction is very simple. Correction is then made by simply entering the errors on the next VAT return. Now, again, based on the information down there may be a penalty for submission of an incorrect return, but there'll be no interest charged. No default interest will be charged here. If the net errors, on the other hand, are more than the de minimis limit, so greater than 10,000 or 1% of the turnover, subject to that upper limit of 50,000 as it says there, if our net errors are more than the de minimis limited, then can again be voluntarily disclosed by the trader. But in this case, the trader must disclose the errors separately to Hmrc. We cannot simply adjust the error on the next VAT return, and penalty interest will be charged. And as we've seen, there may be a penalty for submission of the incorrect return. Now, I said up here that there are three different situations. The third one, errors may be discovered as a result of a control visit. Hmrc, as we know, will make control visits to make sure that we have been correctly submitting those VAT returns. Well, if it's discovered as a result of that, rather than we actually volunteering that information when we discover the error, both a penalty for submission of an incorrect return and penalty interest can indeed be charged.
Well, back now to our FA 2020 notes. And if not indeed, back to the 21st century in terms of technology here. And we've got example 7 to have a little look at. It's not a large example, as you can see, very little information for us to digest. Let's have a little look at what it's all about, shall we? Blanche Limited has made an error relating to an understated output VAT of £8,500 on the VAT return. We have an error on a VAT return, and that error has resulted in an underpayment of VAT to Hmrc. And that is for the quarter through to the 31st of December 2020. What we're also told, for reasons as we will discuss in a moment's time, is that Blanche Limited has a turnover for the quarter of some £700,000. What is it that we have to do here? How should this error be disclosed to Hmrc? So what do we do about informing Hmrc about the error that has been made? And what penalties and interest will be charged to Hmrc? So, penalties and interest And how do we inform Hmrc of the error that has led to the understatement of that output VAT, the understatement therefore of the VAT that has been paid over to Hmrc? Well, we don't have to go back very far in our notes. We're dealing with an error in a VAT return, quite clearly. Right, what you're told here is that there could be up to 3 different situations that we have to deal with. We then look at the outcomes related to them. You may recall here that the third of those particular situations was that one, where the error is discovered as a result of a control visit by Hmrc. They've come in, looked at our records, they find it. That hasn't happened here. We have realised, prior at this moment anyway to any such control visit taking place, that an error has arisen. So we need to do something about it. So it's therefore down to, is it this situation or that, the first or second situation? And that's down to whether or not the net errors here are less than the de minimis, because net errors of less than the de minimis level can be voluntarily disclosed by a trader. Correction is then made by simply entering the errors on the next VAT return. There may be a penalty for submission of an incorrect return, and those penalties, of course, we look at down here in a moment's time. So we need to know about the level of net error. Are we within that de minimis level? If we are, although there may be a penalty, there won't be any interest to be charged. If, as here, net errors of more than the de minimis arise, they too can be voluntarily disclosed by a trader, but in this case the trader must disclose the errors separately to Hmrc. Can't therefore be done on the next VAT return. Penalty interest will be charged, and of course the penalty for submission of an incorrect return may also arise here. So what do we mean by this de minimis level? Well, here we go, and the important word here is about the de minimis level, that it is the greater of. And there you can see that first figure, £10,000. We'll have a look back to the information in the question that we've got here, and we can see that the understated output VAT is only £8,500. Now, we've been given the information there about the turnover for the quarter of £700,000, but actually here we don't need to do anything with that number, because the de minimis level, as we say, is the greater of that £10,000, and that 1% of turnover, that was £700,000, that would therefore be £7,000. The error, the understatement of VAT payable, was £8,500. The fact that that is bigger than that number doesn't matter, for as we've said, the de minimis level is the greater of, and there you go. If that figure there, the understated figure, any number that is less than £10,000 here is going to be below your de minimis level. And on that basis, therefore, we are now looking at this route. So what do we do? The net error is less than the de minimis level. £8,500 is less than £10,000. It can therefore be voluntarily disclosed by the trader. And how do we do that? Correction is made by simply entering the errors on the next VAT return. We don't have to make a separate submission to Hmrc. We simply do it on our next VAT return. Although, as we'll see, there may be a penalty for submission of that incorrect return, but no interest will be charged. So, we've now determined that given the level of the error, we can voluntarily disclose it. All we have to do is to put that through on our next VAT return, and that there'll be no interest charged in relation to this. But what about the penalty here in relation to what has happened? Now again, thankfully, in terms of the penalty system, we don't now have to memorise all the different possible outcomes. That information, as we know, is given to us on the fact sheet that we have, well, on the fact pages within your computer there, but the standard penalties for errors, the rates and allowances information provided in the exam. So what happens therefore as regards that penalty system? Submission of an incorrect return has led to an understatement of a VAT liability, and on that basis, pardon me, itchy snitchy, I think we're okay. What will happen? There will be no penalty where a taxpayer simply makes a mistake. It's just a mistake, no penalty. Also note that the actual penalty, where there is one, is linked to the taxpayer behaviour. So, there will be a moderate penalty, and that's up to 30%. Note, up to 30%. And again, the point there is that any penalty will be substantially reduced where the taxpayer makes disclosure, especially unprompted disclosure to Hmrc. Hmrc have not raised any issues about the VAT return submitted. We therefore, unprompted, go to Hmrc in terms of telling them what has happened here. Again, we disclose it on our next VAT return, as we've already stated there. And that therefore will lead to a reduction in the amount of that penalty. Again, this up to 30% is where a taxpayer fails to take reasonable care. So is that what has happened? The fact that we've identified this may simply be an indicator that what it was simply an error. We failed to take reasonable care. That happens. So therefore we're putting in a maximum of 30% of the understated tax. But if we disclose this, it's unprompted, then the chances are that that penalty will be reduced. If, of course, the error was deliberate, then we move up the scale in terms of a higher penalty. And as we know, that could be up to 70% of the understated tax. If, of course, there is also concealment going on, so we found out it was deliberate, and we have then deliberately concealed that from Hmrc, then of course we could be looking at up to 100%. But on a basis of the fact that it would appear we've simply identified an error that was made, on that basis we should be looking at, as a maximum, 30% of the understated tax. And again, that is likely to be much less. Again, there may be no penalty where the taxpayer simply has made a mistake. Again, it will be down to Hmrc to make that particular judgment. So these two shouldn't be a problem, and worst case scenario is it would be up to 30%. That is likely to be reduced because of the unprompted disclosure, and if they agree that it's simply due to a mistake, then no penalty will arise either. So the best possible outcome, and it is in our interest to act sooner rather than later, as soon as this issue is identified, then on the next VAT return we put that through. And what that may lead to, as well as it will be, as it's less than the de minimis level, no interest being charged on the understated amount, we may also get away without any standard penalty. Now, given that, of course, we'll be looking at objective testing questions where a specific outcome is likely to be required of you, and you have to pick which of the four volunteered to you is the one to pursue, then the information is likely to be very much more specific as regards the nature of the mistake, in terms of, is it simply a mistake made? Are we talking about we failed to take reasonable care, and that's how the mistake arose there? You know, it was something, we've got the numbers wrong. We've taken care over what we tried to do in terms of the transactions, but we still made that mistake. Human error. But again, taxpayer fails to take reasonable care, then on that basis, maximum 30%, or in terms of those figures there. We, in this situation, don't have to worry about the memory lesson in relation to those numbers. Thankfully now that information is provided to us. All we've got to know is how to use that information. Okay, you can have a look at the answer to that in the back, just an abbreviated answer there. The information surrounding this, again, is not something that you're likely to hold in your head for a very long time. As we may have mentioned before, therefore, in these more administrative areas, although we familiarise ourselves during our teaching phase, as it were, we're going through now, the revision for that is going to be secondary to the revision and practice in relation to the doing things, how to prepare those computations, income tax, corporation tax, capital gains tax, the NIC computations, the IHT computations. All of those are fundamental. If we can't do those and do them to a high degree of accuracy, then we would struggle in the exam to achieve our pass. If we can achieve that high level, or reasonably high level indeed, then it doesn't matter about the peripheral detail. But of course, once you have practiced during the revision phase and you are confident and competent so far as the computational issues are concerned, then of course you may focus at that last point over the last few days on some of the more administrative issues, whether it be in this chapter as regards what we are now looking at, whether it be in terms of, chapter 15 or chapter 23 in relation to the administration of the personal taxes in chapter 15, corporate tax in terms of chapter 23. Yes, there will be section A questions undoubtedly that test out this system, the admin. But again, it is not something that you try to fill your head with through the teaching phase. Familiarise, understand what information is provided to you, appreciate therefore what's surrounding that you have to learn, but the learning of that will go through closer to exam date. Make sure you can do the important stuff before you put the icing on the cake. Okay, that brings this particular session to an end. And again, next time we'll be moving on to look at, well, things that Hmrc have done to try to help small businesses. Yeah, Hmrc being helpful. There's a surprise. We'll talk to you then.